There's a difference between making thoughtful, formulaic adjustments in your portfolio and reacting to headlines. So your goal and subsequently your investment strategy should not rely on you having to guess what the next short-term market movement is going to be. Your goal is to arrive at retirement with a portfolio that can support your life.
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Well, welcome to this episode of Pilot's Portfolio. I am glad to have you along with us today. My name is Timothy P. Pope. I'm a certified financial planner specializing in the planning needs for professional pilots, and I'm also a principal at 360 Aviation Advisors, where we help successful professional pilots really integrate their financial planning with a well-rounded focus on retirement, investment, and tax. Now, we help our clients plan for and navigate life's inevitable transitions. So, folks, glad to have you along for today's show. Today, we are talking about something that comes up almost every single time the market gets a little noisy, right? And this idea is preparing for retirement during turbulent times, because there is always some form of turbulence in the market. Our markets are efficient, which means it can allocate capital kind of quickly, right? So sometimes it's inflation, sometimes it's recession concerns, sometimes it's a sector crash. Sometimes it's geopolitical tension, and that's what we've been experiencing here recently. Recently, we've seen renewed uncertainty tied to events in the Middle East, primarily the war with Iran right now. So we've seen pressure on energy markets. So the cost of energy has skyrocketed. And then, of course, the ripple effects that are going to come from that. We expect to see that with higher inflation, probably the longer the conflict lasts. And then the equity markets certainly have been volatile. So if you're 30 years old, that's one conversation. But if you're about 5 years from retirement, that's a completely different conversation. So today, I want to speak directly to the pilot who is in that final stretch, probably mid-50s, late 60s, strong, actually, not late 60s. Not if you're at the airlines, not late 60s, right? So right, mid-50s to early 60s, strong income, strong balance sheet. And you're really starting to think about your transition into retirement and what that looks like. Because at this stage, the question's no longer, hey, how do I grow? You've done that. The question becomes, how do I protect it? You don't want to have to do it again, and you don't have time on your side to do it again. And then follow-up questions like, hey, well, how do I actually use it? Okay, I've got this 7-figure balance. How do I use this account? And then for the amounts that I don't use, how do I transition it in a smart way? Okay, so when you're 5 to 10 years from retirement, your financial life starts to change in a pretty significant way. You're still investing. You're still growing your accounts and your assets. But now you're also starting to think, well, how much downside can I tolerate? Right? How much cash or liquidity do I need? What will my spending look like in retirement? And what happens if markets are down when I retire? It's normal that market turbulence you begin to have these questions come up in your mind. And I think when the questions show up, quite honestly, it exposes whether you've already answered them. But in my experience, what I've seen is that even clients who have answered these questions, when the market gets a little turbulent, they like to come back and double check. And that's okay. That's healthy. I think that's healthy because you've never retired before. So you want to make sure that you're getting it right. You want to make sure that your plan is in tune and it's incorporating, the latest information in the current reality. All right, so let's start with the foundation here, right? Your asset allocation, your mix of stocks, your bonds, your cash. These are the building blocks. When you think about building your portfolio, these are the building blocks, right? So do you actually have the right mix of stocks, bonds, and cash for where you are today? This idea of having the right mix cannot be understated. A Vanguard study found that more than 80% of your returns are going to come from your stock to bond to cash mix, right? So number one, that's huge. And number two, a lot of the volatility that you experience is going to be directly correlated to your mix, right? So your mix should be appropriate for where you are today, not 10 years ago, right? Not where your colleague is, with the folks that you fly with or your friends or so on. It should be where you are today. And I see this a lot. The markets over the past 17 years, they have done very, very well. We've had some momentary interruptions, but they haven't really been prolonged, to be honest with you. So a lot of guys have gotten really used to, well, hey, the market bounces back quickly. So that means that there's confidence, right? And maybe a little complacency around their investment strategy. I think most of the time when folks are, they're fairly close to retirement and they still have a lot, maybe a high equity exposure, a lot of stocks, I think it's due to inertia, to be honest with you. Hey, that's how they've invested in the past. It's worked for them in the past. They haven't had a whole lot of, thought about how entering the next phase of their life is going to change what they require from their investment accounts. And so it's like, hey, this has worked. But when you're 5 years from retirement, your portfolio, it still needs growth. Yes. If you're retiring at age 65, would like to plan for another 2.5 to 3 decades of life, which means your portfolio still needs to support everything that's going to come at you 2.5 to 3 decades of life. So yes, it needs growth, but it also needs stability and liquidity. So stocks are going to give you that long-term growth. Bonds can help reduce volatility, right? They're there to act as a stabilizer. Cash, we don't invest in cash for returns, right? But it's there to give you flexibility. And flexibility becomes incredibly important and valuable as you approach retirement because timing matters. When you need to take money from your portfolio matters. The tax consequences still matter. And so your allocation should reflect that. It's it's a basic building block when we think about building portfolios, but it's a huge one that's going to reflect both your returns, but also the volatility, the ups and downs that you're going to experience as you enter retirement. Let's move on. Let's talk about this next part. Let's talk about emotions. All right. And avoiding big emotional bets because, when we think about this and managing our own investor behavior, this is where I see a lot of mistakes. When markets get volatile, when headlines get loud, when there's geopolitical uncertainty, when there's uncertainty here at home, right? It becomes very tempting to make really big moves with your portfolio. Sometimes it's, well, hey, you know what? I'm going to jump out. I'm going to move everything to cash. I'm going to try to wait it out and then get back in. Well, on paper, that sounds really good. But to be honest with you, to do it really well, you'd have to jump out at the first sign of trouble, and then you'd have to jump back in at the low. And in reality, if you're the investor who wants to jump out at the first time of trouble, first of all, it's not going to be clear. Secondly, it's going to be really noisy. It's going to sound like the world is falling apart. And that temptation to stay on the sidelines means you're probably going to miss the low. So I do not recommend, particularly if you're 5 years from retirement, you can't recover from that kind of mistake, right? So, we see folks wanting to move to cash, try to wait it out, get back in, or say, maybe I want to wait till this recovers, right? Maybe you have cash that you need to invest. Maybe you got, an inheritance or some other influx of cash. And you say, hey, you know what? I'm going to wait until the right time. Usually when folks say the right time, it means the markets have recovered. They're on their way up and prices are more expensive then than they are today. So that's another, emotional mistake that, I would say, hey, avoid. Sometimes I'm going to double down on a specific sector. Right now, energy's hot. Brent crude is soaring. Energy funds that have languished over the years, they are making a comeback, right? So maybe folks want to double up on a specific sector. So with all of those points that I just made, I want to be very clear. You want to avoid making large emotional bets with your retirement accounts, especially within 5 years of retirement. Because at this stage, the cost of being wrong is way, way, way higher than it was for you when you were earlier in your career, right? So you don't have the same time horizon to recover from a major mistake. In other episodes, I talked about time being a huge lever. Well, when you're on the doorstep of retirement, you don't have that huge lever of time to recover from a mistake. There's a difference between making thoughtful, formulaic adjustments in your portfolio and reacting to headlines. So your goal and subsequently your investment strategy should not rely on you having to guess what the next short-term market movement is going to be. Your goal is to arrive at retirement with a portfolio that can support your life. And so here, 360 Aviation Advisors, we believe in capitalism, right? We believe that it's going to make us money over time. We believe in the efficiency of the markets, which means that they can be extraordinarily messy and a noisy place as markets absorb new information and they allocate capital towards, future returns. So we believe those things. And I'll tell clients, and we'll talk about, hey, when we discuss our investment strategy, I'll tell them, hey, look, the way that we think about building portfolios and managing money is a really effective way at providing risk-adjusted returns over time. It also just happens to be a really boring method. And it should be. We take the emotions off the table, and that has saved a lot of people a lot of money over time. When you think about preparing for retirement in a turbulent time, avoid making huge emotional decisions with your retirement account. Now, before we keep going, I'd like to mention this. At 360 Aviation Advisors, we help successful professional pilots who have outgrown DIY investing. We help them coordinate retirement planning, investments, and tax decisions with ease and clarity. Because at a certain point, building and preserving wealth to support the life you enjoy takes a team. To learn more, visit 360aviationadvisors.com. That's 360aviationadvisors.com. Now back to the show. Let's talk about using your strong cash flow while you have it. It is a practical point that often gets overlooked, but look, you guys at the airlines are doing very well right now with your contract and your compensation, your pay right now. And if you are just on the doorstep of retirement, you're probably making very good money, and while you're still earning strong income, you want to use that income strategically. So this is the last stretch where your paycheck is still doing a lot of the heavy lifting. So you want to ask yourself, okay, what can you do now while you have strong cash flow that you would rather not fund from your portfolio later? So some examples are, hey, are you planning to stay in your home? Are there updates or improvements that you've been putting off? Well, maybe it's a really good time while you have that strong cash flow to go ahead and make those updates or those improvements. Are you planning to sell your home? How much is it going to cost to get the home ready for sale? Does the home have sufficient equity to transfer to your new place? Maybe you ought to buy your retirement home now while you have the cash flow and you have the income. And then you can slow that transition down. You can put time on your side. You can reduce your stress and then eventually sell your current place. Are there known upcoming expenses that you're going to have to take care of? Maybe the kids' weddings. Maybe have you always wanted to put a pool in? Hey, pools can easily run 6 figures. Maybe you want to put a pool in. Do you need to replace, a deck if you're out on the lake or, out on the beach? Do you need to buy new cars? Those kind of things, right? So those largely one-time expenses that can be a high ticket item. Can we accelerate those now while we have a paycheck coming in so we don't put that kind of pressure on our retirement account in the future? And when you think about it, it's not necessarily, hey, I'm going to retire, I'm going to go on a spending spree. It's not necessarily that, but it's reducing the future pressure on your investment portfolio. Because once you retire, your portfolio becomes your primary income engine. And so the more you can prepare ahead of that transition, the better. So moving on from those one-time large expenses, let's talk about regular expenses in retirement, right? As you approach retirement, you want to be able to clearly distinguish between what's required for you to spend, keep the lights on, call it the hug money, right? Housing, utilities, groceries, that kind of thing. And then what's discretionary, okay? So we think about what's required: housing, insurance, health care, food, taxes, transportation, that kind of thing. And then we think about discretionary expenses: travel upgrades, optional purchases, lifestyle enhancements, right? And the reason that you want to enter retirement with this going eyes wide open on these two buckets is because in a turbulent market condition, your flexibility matters. If you know what it takes to just keep the lights on and do your day-to-day, then when the market gets really turbulent, you already know what your baseline is, and you can easily turn off some of the discretionary. And in fact, when we build plans, instead of lumping it all into one, particularly as you get closer to retirement, we'll say basic living expenses, and then we'll say retirement discretionary expenses, right? And so when we run models, we can bring retirement discretionary expenses down to zero. We can cut them in half, as we look at different market conditions. So when you think about that, you have options, and having options is a form of control. When I'm talking to clients, we focus on controlling the aspects that we can control and then not stressing about the aspects that we cannot control. Because believe me, investing in the marketplace, there's a lot of things that we cannot control. And so knowing the amount of flexibility that you have in your retirement spending is something that you can control and something I would advise for you to do as you approach retirement. All of your career, you have focused on saving into these accounts. And now it's time for these accounts to serve you. So let's talk about how you're going to be spending from these accounts. Because saving it's only part of it, right? So at some point, we're going to need to, I call it, turn the income on from these. So, I think a lot of folks are understandably less familiar with this spending process because, like I just mentioned, up till now, you've been focused on savings. But when you're within about 5 years of retirement, you should start thinking about which accounts will I draw from first? How will my brokerage account, my pre-tax account, my Roth accounts, any passive income that I have coming in from real estate and so on, how are those going to interact? How will I manage taxes during my retirement years? Do I expect to be subject to extra Medicare taxes via the IRMA, the income-related monthly adjustment amount? If so, how long will I be subject to IRMA? What withdrawal strategies will allow me to sleep at night? That's a big one. That one, just because somebody else is doing something doesn't mean you have to do it. So I always like to tell folks, hey, what's going to help you sleep at night? I call it sleepability. If you're able to sleep at night with your strategy, it means you're probably going to stick with your strategy, and your success comes from being able to stick with your investment strategy. When you think about your withdrawal strategies, it's like, hey, how much of a cash buffer do I need to avoid selling assets in a down market? Where will I keep that cash? Am I going to use CDs or treasuries, or are bond funds sufficient? This is where your coordination becomes critical, because the order that you withdraw from your accounts can really impact, number one, how long your portfolio lasts, and then number two, your overall tax outcome. And so this is something that you certainly want to know what to expect before you receive the final paycheck, before you set the parking brake for the final time and you begin your retirement.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Here's a few quick hits for you that you may already be doing, and if you're not, you certainly want to think about doing. Look, rebalancing, okay? So big market movements certainly are a time and opportunity to rebalance. I always we want to have our rebalancing parameters set before the market movements happen, whether it's down market movements like we've been experiencing so far this year, or whether it's really strong market movements. We want to have our retirement parameters set. So go ahead and rebalance, make sure that our allocation we haven't drifted off of our risk profile. Debt, just think about that. So, hey, what debt do I expect to be carrying into retirement? And how is that going to impact my income? A lot of times, a lot of folks want to pay off a mortgage in retirement. Sometimes even if it's a low interest rate, they just don't have to worry about it. Like, it helps their sleepability factor. Other folks say, hey, you know what? I've got a super low rate on this mortgage. I'm okay adding that to, my fixed cost in retirement. I'm going to have enough. It's going to be fine. Right? So there's some personal preference there with the mortgage as an example of debt. Stress testing. All right. So what happens if the markets are down in your first couple of years of retirement? That's a huge one. We start to think about sequence of return risk, right? My portfolio's down. How much can I withdraw from it before I run out of trouble or before I drastically alter my retirement outlook, right? So the questions start to be like, hey, will I be okay? You start to think about stress testing, and are there discretionary events or expenses that you've planned in the first couple of years of retirement while you have your health, your ability to enjoy things and so forth? If the market takes a downturn, do we have to shift those expenses to, a few years later? So that's all part of stress testing. Then we think about emergency reserves, right? So is your current cash position appropriate for someone transitioning into retirement? I'll tell you, because in retirement, we don't have a steady paycheck like you have throughout your career. A lot of times folks will like to carry a little bit more cash. And what that does is that softens some market downturns. Hey, if the market downturns, that's okay. I don't need to pull from the portfolio, or at least not to a larger extent. I can use this cash when the market recovers, then I can replenish my cash position, right? So what's going to help your sleepability when it comes to your emergency reserves and the cash there? So as you guys well know, as you are taking your trips and in aviation in general, like, hey, when we run into turbulence, it certainly gets our attention. Doesn't change our destination though. It changes how we manage the aircraft along the way. Certainly we stay disciplined and we're aware, right? We trust our training and our systems. And financially, it's very similar, right? So market turbulence should not cause you to abandon your process. In fact, it's going to reinforce the importance of having a process, right? If you are 5 to 10 years from retirement and the recent market turbulence has caused you to step back and ask whether your portfolio or your liquidity or your overall plan is really aligned with what's ahead, right? I think that's a really good instinct. I think that's normal. You can visit 360aviationadvisors.com. That's 360aviationadvisors.com. You can find the link in the description. And when you're ready to begin a coordinated effort that ties all the parts of your financial life together as you transition into retirement, you can schedule a conversation, right? So let's talk. So I just want to thank the sponsors of this show, the team at Beacon Relocation, for their support and their support of you guys as they save you money on your next real estate transaction. And I want to thank you, the listener at home, the pilot at home who tunes into the show. So I hope you found this helpful. And look, I think today we were focused on folks that are 5 to 10 years from retirement. I think even if you are not 5 to 10 years from retirement, you probably found something that could help yourself. So thanks for joining this episode, and we'll see you on the next one.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's Portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.